Be Wealthy and Smart, episode 602.
I'm gonna live the rich life, full and best life. So if y'all know what I mean, put your hands up and declare with me. Yeah, I'm full of it. I'm gonna live the good life, beautiful and glorious life.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to compare the S&P 500 ETF to the Total Market Index ETF. Because recently I got a listener question and they were wondering, should I do traditional asset allocation or should I stay in the total market index that I'm in? So if you've been listening to the show for a while, you know that typically in asset allocation, I talk about having some large caps, which generally is the S&P 500, the 500 largest companies in the US, along with a mid-cap ETF, a small cap ETF, an international ETF, and perhaps emerging markets, real estate investment trusts, and then we have our specialty sector ETFs as well. So I talk about traditional asset allocation in that way, being very specific about your ETF selection and covering all of your bases with your asset allocation. But this listener brings up a good point because a total market index ETF is basically investing in the entire stock market, which includes not only the large companies, but also some medium-sized companies and smaller companies. The difference is the S&P 500 ETF is only going to invest in those 500 largest companies versus the total stock market index is going to invest in about 3,600 companies. So vast difference in the number of positions that you have within the ETF, and you have a broader brush. You're basically buying the entire stock market with the total stock market index. Now, within the total stock market index, you're getting about 77% large companies or large cap stocks. So that versus 100% in the S&P 500. So you can see right there, your asset allocation is different by almost 25% of the portfolio. But when we look at things like dividend yield, they're almost identical, 2.06% for the S&P versus 2.04% for the total stock market index. And your expense ratios are identical at 0.04%. When we look at performance of the S&P 500 versus the total stock market index, the total stock market index over the last 15 years has performed better. And we would expect that because remember, it's only 77% large caps, and so it's got some small caps. About 9% is in small caps and the rest is in mid caps, medium-sized companies. So you've got your coverage of small, medium, and large in your total stock market index. Therefore, when smaller companies are performing better, you're going to get some of that performance, 9% of your portfolio is in smaller companies. So you're going to participate in some of that small cap performance when small caps outperform large caps. The problem is the total market index has only been around since the early 90s. So we can't go back and have the track record from 1926 that we have with the S&P 500. So we can't compare the full range of apples to apples. We just don't have the same track record. And remember, we're not comparing the S&P 500 as a one decision investment. We're comparing the S&P 500 plus all of these other asset allocations to your portfolio. So we'd have to compare a total diversified asset allocation to the total market index. So just if you were looking in the US, yes, you could use it as a substitute for your small, mid, and large cap allocations, but you still need to allocate money to international, emerging markets, real estate, and your sector funds. So you want to still have additional assets in your portfolio. The reason why I recommend the S&P 500 and the asset allocation that I do with mid-cap, small-cap, international, emerging markets, real estate, etc., is because people generally have those as choices in their retirement plans. Not everybody has the total market index as a choice in their retirement plan. So by me separating out each asset class, usually more people are going to have access to that choice. And so I'm trying to make it easier and something that more people, more listeners actually have in their menu of their 401k that they can actually choose and apply. So that's the main reason. It's not that the total market index is better or the S&P plus mid caps and small caps is necessarily better. But I do think if small caps outperform, you are going to see better performance if you allocated each of those asset classes individually, because you would own a larger percentage in small caps than 9%, and therefore you would own the better performing asset in a bigger percentage in your portfolio. But really, it comes down to almost splitting hairs, because for the last 15 years, the performance has been darn close. And as I said, we don't have the longer term track record with the total market index, but you have great performance there. So if you already own the total market index, I would just keep that. I wouldn't sell it to reallocate. Unless small caps really started going gangbusters and you saw that you were underperforming, then you might want to reallocate and have a bigger percentage of your portfolio in small caps. Small caps typically do well when you're at the end of a bull market. They typically do well when you're going into recession. And smaller companies are those little speedboat companies that can make changes, don't have to lay off a lot of people, they can develop new products or cut expenses really quickly and get more profit to their bottom line. So in a recessionary type environment, small caps can really outperform. But when the market is doing well, when interest rates are low, your large companies, your global companies, they can sell all over the world and they can bring a lot of profit to the bottom line. One thing that's good about the total market index is it is one decision investing. You basically can make one decision and you're invested in small, mid, and large caps in the US, and you've got that part of your asset allocation covered. So it's really almost like splitting hairs at this point. I like the control of being able to create my own asset allocation and put everything into the pie pieces like I teach you to do. But if you have the total market index as a choice in your retirement plan, it definitely is a good option to choose that and have one decision covering your small, mid, and large caps. I don't have a problem with that at all. So I hope I've provided some illumination on the difference between investing in the S&P 500. Remember, we never want to have 100% of our assets in the S&P 500. That is putting it all in the large cap piece of the pie. And you also need to have the mid caps and the small caps if you're going to own the S&P 500. With the total market index, it's doing that for you. So in that one decision, you own small, mid, and large cap companies. I think ultimately both are great because you have the opportunity to compound at a high rate. And that's really what we're talking about here. We're talking about how you're going to get those higher compounding rates of return that are going to help you retire early, help you get more in your account, help you continue to outpace inflation, and achieve all of your financial goals for financial freedom. So really, we're splitting hairs, but I hope that I've given you some clarity on the different strategies and understanding a little bit more of the finer tuning of asset allocation. I would say the bigger point here is to make sure that you're not parked in cash or not parked in low interest rate bond funds in too big of an allocation where you're going to underperform and not get to those higher compounding levels. That would be the more important lesson here in your asset allocation. But whether you have the total market index or the S&P 500 plus mid caps and small caps, you're going to, in my opinion, do well because you're invested in high growth companies that are likely to do well over the long term if they continue performing the way they have in the past, which I don't have any reason to believe they wouldn't. So the point is, you're investing in growth, you're going to get to the higher compounding rates. I think you've made good decisions no matter what you choose. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be updated as soon as new podcasts are available. And don't forget, we have our summer sizzle contest going on where you can win a wealth mentoring session with me. 10 people will win the Wealthy Mindset Blueprint audios with me, valued at $197, and 10 people will win a signed copy of my Wealth Heiress book, which was selected by bookauthority.org as one of the best wealth books of all time. All you need to do is leave a podcast review on iTunes or Stitcher Radio if you have Android. That will put your name in the drawing one time. And if you leave a book review on Amazon, that will get your name in the drawing 2 times. Winners will be selected August 28th, and they will be announced on the August 30th podcast. And don't forget, if you want to look up more podcasts about asset allocation or paying off debt or any of my other topics, go to my website, lindapjones.com/podcasts, PODCASTS. And there is a search box in the upper right-hand corner. You can type in whatever you're looking for and find the topic through all 600 of my podcasts. Remember, iTunes only carries the most recent 300 podcasts. So you've got to go to my website to get all 600 of my podcasts. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.